Swayam Prabha. Digital India. Educated India.
Namaste. Hello. I'm Dr. Diksha Munjal. I teach at the Faculty of Law at University of Delhi. So today we'll be starting out with Principles of Taxation, which is going to be your course that you will study overall. And for today, we will focus at the first lecture, which will be introductory in nature. So let's get started and understand what is this concept of taxation. How is it that where we are today in terms of taxation, and what are the different terminologies at the very basic level to be able to understand taxation better. So the contents for today are such. One, we are going to understand what is the concept of tax. Secondly, we will look at the different types of tax. Then we will look at some important definitions which are key to understanding the taxation principles. These definitions will include the definition of income, person, assessee, what is the assessment year, and the previous year. And after we understand these definitions, we will look at the basic concept of application and diversion of income. So let's start with the first part, which is the concept of tax. So when we understand this concept of tax, we are going to essentially trace the origins of where tax came from. So if we look at the law of taxation, that is clearly not new or of modern origin. If we go back in time, we will see that tax has always been there with us. So in ancient India, taxation was a very well developed system and was imposed in some form or another. The references to taxation are found in the Manusmriti as well as Chanakya's Arthashastra. It was a well-developed system in India even over 2000 years ago. So the levy and collection of tax was an important function of the sovereign, as it was the collection of tax which strengthened the treasury, which consequently ensured a robust treasury leading to greater security being rendered by the sovereign. In British India, tax was formally conceptualized and imposed in 1860 to deal with the losses that the crown had to bear due to the revolt of 1857. So after a number of tests and trials by the Britishers, the Income Tax Act of 1922 was enacted and a formal law of taxation was laid down. The law remained in force until 1961, when the Income Tax Act 1961 was enacted in independent India. The law of taxation in the present day, thus, is the Income Tax Act of 1961, which we read together with the Income Tax Rules of 1962, the Annual Finance Acts, circulars, instructions, and guidance notes, which are issued by the CBDT, that is the Central Board of Direct Taxes, and the various judicial precedents. So the power to tax is basically a sovereign function which emanates from Article 265 of the Constitution. The provision states that no tax shall be levied or controlled except by authority of law. Therefore, the levy and the collection of tax by the state must be under the authority of law. So let's look at what are the different types of taxes. Before we move to that, I would want all of you to go back and rethink of the times that you might have paid tax. You all have. Either you have paid it knowingly and as a part and parcel of your regular income that you are getting on an annual basis, right, on which you are paying something known as income tax. And the other part is one wherein you are paying it unknowingly. For example, let's say for instance, wherein you go and you buy yourself a set of stationery items. All of those stationery items, from pencil, eraser, sharpener, a stationery pouch, everything has got a tax component to it. So if you go back and you recall, you will realize that for every single thing that you have paid up until now, you will read that there is this thing known as MRP. And then in the bracket it says inclusive of all taxes. So when you read this amount MRP inclusive of all taxes and then it says rupees 10 for example, the 10 rupees that you are paying is not something that is devoid of taxes. Taxes have already been included onto that, and then we are calculating the maximum retail price. That means you cannot sell it at a price that is higher than 10 rupees. You can of course sell it at something that's lower than 10 rupees with the tax component already attached therein. So all of us have paid taxes irrespective of whether we are getting some regular income or not, because obviously we are going and purchasing goods, services, etc. on which we are paying tax. Another fine example would be, let's say for example, you go and you eat in a restaurant. When you eat in a restaurant or a cafe, you will see that when you call in for a bill, there is a whole list of amounts which are provided therein, right? So when you read through all those amounts, at the very bottom you will read the tax component. So you will have the GST aspect attached to it. So when you are paying the bill at the restaurant, again you are paying tax as a component of that entire total bill payment. So let's look at what are the two different types of taxes. One is the direct tax and the second is the indirect tax. Direct taxes are basically taxes that are levied directly on the taxpayer who pays it directly to the government. So the tax liability does not shift to another person. For example, in case of income tax, property tax, etc. In case of indirect taxes, indirect tax is levied on goods and services by the government. The liability can be shifted from one tax-paying individual to another. For example, in case of GST, the liability is of the wholesaler, but then that gets passed on to the retailer and then finally to the consumer. So when we read something known as MRP inclusive of all taxes and we are paying that amount of 10 rupees, right? So we as the consumer are paying that 10 rupees, but the liability was something that has been passed on to the consumer. So when this amount of 10 rupees is paid, when the amount goes back, that's how the retailer and the wholesaler are actually able to meet out their liabilities from this 10 rupees. But if you contrast this with direct taxes, you will see that, let's say for example, there is a person who has earned some income, right? This person's income is something that cannot be attributed to another person. That is not possible, right? This is not possible. So over here, this person A who has earned that income, the tax has to be paid on that income by A himself or herself, right? So let's look at what is this definition of income. So now we'll be looking at various definitions, the first one being income. And income has been defined under section 2 clause 24 of the Act. It states, basically there are a lot of components within that definition. Let's look at it in fine print now. So the Act basically defines under section 2 clause 24 in an inclusive manner and not in an exhaustive manner. So the definition enumerates what all may be treated as income for the purposes of taxation, and it includes profit and gains, dividends, any illegal income arising to the assessee, any income that is received at irregular intervals, any taxable income that has been received from a source outside of India, or any benefit that can be measured in money, any subsidy or relief or reimbursement, the gift which has been received, the value of which exceeds rupees 50,000 without any consideration by an individual or HUF, any prize, any casual income that is arisen, like for example winning out of lotteries or horse races or gambling, etc. So if we go back onto this slide and we see, if you look at this part, any illegal income arising to the assessee. So when we look at it, the first thing that comes to our mind is that why is illegal income being included, right? So for example, somebody is caught smuggling, okay, and there is a whole lot of cash that is seized. Now, because you have hoarded up currency and you have obviously not paid tax on it, that income that you have hoarded, right, that is nothing but your illegal income that you have hoarded. You have not declared it. And as a result of that, whatever income you have paid on your legal income, that means, so when you have received income from different sources, put it through tax assessment and paid tax on it, right, and that would be considered as your legal income. And then you have probably been smuggling things, right, and earned some income out of that. So when you're smuggling, when you're hoarding, right, all of that income that you are getting is nothing but your illegal income. And when you get that illegal income, and of course when you're caught, at that point of time, this illegal income will be subject to penalty, right, whatever may be the penalty, and with that the tax component also comes. So it's not that you will only pay penalty. So you will pay penalty along with tax, right? And therefore, when we look at the concept of income, we are not bothered about whether your income is legal. We are not bothered whether your income is illegal. We are not bothered whether your income is a regular income, right? We are not bothered whether your income is an irregular income. So what is this regular and irregular income? Regular income, let's say for example, you are in some sort of service, right? And you are getting your income on a monthly basis. Or let's say for example, you are running a business and you're getting your income on a regular basis. You are probably renting out your house property and you are getting some rental income on a regular basis. So that is when we say that the income is regular income. But at times, there might be irregular income. So if you see that there is a person who is running a business, who has just probably started out business, okay, and that person is not getting regular business or is probably even carrying out a business which is seasonal in nature. So when this person is carrying out a business which is seasonal in nature, let's say for example, the person wants to make woolen clothes, okay, or maybe wants to do some sort of business which is seasonal where agriculture is concerned. So let's say the person is growing mangoes. So mangoes you cannot harvest throughout the year. Similarly, you are not going to sell woolens throughout the year, right? So when that happens, obviously your income would be an irregular one from that particular source. And therefore, at that point of time, we say that there is an irregular income. But when we talk about taxation, we are not bothered whether your income was a regular one or an irregular one. Everything gets included when we look at taxation as a concept, because we are going to look at your overall income, right? Okay. So let's look at this case of CIT versus GR Karthikeyan. This is a classic case. There was this a person, GR Karthikeyan, he was basically into motor rallying. So if you see motor rallying is a very different sort of form of racing compared to simple motor racing. So if any of you are enthusiasts of Formula 1 and you know about Michael Schumacher, he is basically into motor racing. And if you recall ads which come on TV of all the high-end SUVs, you will see that there is this component of off-roading. That means you are not going on the normal road tarmac, right? You are going into the rivers, you are going into the sand, you are going onto terrain which is off the road, right? And there is this concept of motor rallying which takes place wherein this off-roading concept comes through. So you are going on different types of terrains, where in case of motor racing, you've got a fixed track, right? So in this fixed track, you go around this loop again and again and again, right? and then depending on how many laps you have covered, we say that you have won a particular race. In case of motor rallying, as we see from the case of G.R. Karthikeyan, there was a fixed set of rules which were there, right? Now you had to follow these rules, and whoever has the least amount of violations between point A to point B, from your start point to your finish point, right? So whoever has the minimum amount of violations, that person will be considered as the winner. Now over here, G.R. Karthikeyan had won a particular amount, right? So he had got this prize money, and this prize money that he had received, that was being subject to tax. So G.R. Karthikeyan over here had contested that, well, he had won the prize, right, the prize money from motor rallying and not racing, right? So if you look at the definition talks about racing, but it does not talk about motor rallying. So now the question was that, could you say that motor rallying is equal to racing? So over here, the Supreme Court looked at this particular set of facts and said that, well, if we look at certain components, right, so let's say A, B, C, D are different types of incomes that have already been provided for within the Income Tax Act, right? And then you've got some sort of an income which looks like this. Okay, so it's trying to mirror what is there already in the Act, even though it is not clearly what it is in the Act, right? So let's say, for example, we are looking at A, right? Now there is a difference between capital A and a small a, right? So when we are looking at this capital A which has been provided for in the Act, then we can exclude small a only when there is an exception for it within section 10. Okay. So when there is an exception for it within section 10, then we can say that, okay, fine, we will not impose tax on A. But over here, this was not the case, right? Over here, this aspect of A was to be included. Why? Because it clearly did not fall within the exception under section 10. And because it did not fit within the exception of section 10, the court said that, well, it is also to be seen that, one, it is not fitting under section 10, and two, it is already mirroring something which is provided for in the Act. So when something is already provided for within the Act, and simply because it has not been expressly included, the court said that we are going to give it an interpretation which is inclusive in nature. So where you look at small a and it is mirroring something of capital A. So small a over here was rallying and capital A was the racing part of it, right? So if you compare a motor rally to a motor race, it's going to be of a similar nature. There's not much difference between the two if you look at it from the broader perspective. Of course, different types of races get fine-tuned according to the different rules, etc., which are provided for therein. Thirdly, the court said that when we are saying that we are going to tax casual incomes as well, wherein you're not putting any skill, right? So when you look at lottery, there is no skill that is really attached, right? If looking at horse race, that is nothing but a way of gambling, but the court or the definition also provides for gambling separately as well, right? So the court said that where there is a taxation of income which is casual in nature and where there is no skill involved, when we are going to tax those, then why not tax those incomes where there is some sort of skill involved? So over here, the court said that we are going to tax this amount of prize money which Mr. Karthikeyan had won, irrespective of whether or not this concept of motor rallying was expressly included in the definition of income, right? So the reasons were, one, that it did not fall within the exception, right? So not within the exception. Second was that it was already mirroring something that was provided for within the Act. And third, that it was an income which you were deriving on the basis of you exploiting your skill that you had. And therefore, the court said that we are going to impose tax on this prize money. I hope that this case is clear to all of you. Next, we will look at the definition of person. So when we talk about person, usually we understand people as you and I, and we do not go beyond the scope of understanding you and I. So when we look at this concept of person, the Income Tax Act actually broadens the scope and makes us understand that person does not always necessarily mean an individual. So it does include individual, but not always constrained to this concept of an individual. So who all does it include? First is, of course, an individual, right? Then the definition says that it will also include something known as a HUF, which is a Hindu undivided family. Then we've got a company which is incorporated under the Companies Act. Then we've got a firm, including the limited liability partnerships. So over here we are including partnerships including limited liability ones. Then we talk about something known as Association of Persons or AOP. It also includes body of individuals, which is BOI, irrespective of whether they are incorporated or not. And then they talk about local authority and every artificial juridical person. So if we go back and we see what are these definitions, I do not think I need to explain who is an individual. Then we look at what is a Hindu undivided family. So Hindu undivided family is one wherein basically there is a united family which is living together. A Hindu, which is basically a Hindu undivided family. So no partition has essentially taken place within that family. Then we look at the company which is incorporated under the Companies Act, a firm which is a partnership, and then we look at this rather new concept of association of persons or body of individuals. Now what is this association of persons? So if you look at what is this concept of AOP, when we look at the definition of person, we have seen that it includes all of these people, right? An individual, an HUF, a company, a firm, of course we are discussing this, a local authority and artificial juridical person, right? AJP. So when we talk about association of persons, we are saying that it can be a combination of any of these, right? So let's say for example, you want to carry out a joint venture, okay? And when you want to carry out this joint venture, you want to get more people on board. So let's say for example, you've got a company coming together and then you've also got a firm coming together, right? Both of these together for that joint venture are forming nothing but an association of persons, okay? Similarly, we have this concept of body of individuals wherein there are many people who come together, okay? So let's say for example, you want to start a small cafe, right? If you want to start a cafe with 5-6 people together and all of them come with their different set of skills and different inputs. So you've got person A, B, C and D. A is for example providing the capital, B is providing the place where the cafe is going to be run, C is providing some sort of skill set, right? And D is somebody who is going to take care of the overall human resource functioning on a daily basis, right? So when these four people come together, they may not necessarily want to form a partnership. Okay. If they form a partnership, that's great. If they do not want to form a partnership, then they will be nothing but body of individuals. So just because you are not running a partnership for the purposes of CAFE does not mean that you are not liable to pay tax. You will be liable to pay tax as nothing but body of individuals. And then you've got local authority. So local authority will include within its ambit authorities like you've got Municipal Corporation of Delhi, right, or the Delhi Jal Board, and so on and so forth in your own respective municipalities wherever you may be located, right. So those are all nothing but your local authorities, and they are also liable to pay tax. And finally, you've got the AJPs, which includes trusts which are formed, societies which are formed, etc. Okay. So you've got trust, societies, so on and so forth. You've got cooperative group housing societies, right. So all of these together will form nothing but the artificial juridical person. So all of these persons will then go on to be assessed for taxation, and these persons will go on to be referred to as assessees under section 2 clause 7 of the Act. So if we look at assessees under the Income Tax Act, they will be categorized as follows. One is the regular assessee. Who's a regular assessee? A person by whom tax is payable for the income earned during the financial year under the Act is a regular or normal assessee. This includes payments made on account of any interest, penalty, etc., or where a refund is payable by the government. So sometimes we end up paying more tax and then the government refunds us. And then you have got a deemed assessee. So a deemed assessee is a person who is entrusted with the responsibility to pay the taxes on behalf of a third person by legal authority and is referred to as the deemed assessee. For example, you've got an agent of a non-resident who is receiving income from India, or a guardian who may be liable to pay tax on behalf of the minor or a person of unsound mind, right. So let's say, for example, there is a child who is liable to pay tax, okay, but will not be taxed because children are not supposed to pay taxes, right. So when they are not supposed to pay taxes, who pays the tax? Does everything get into the child's pocket? No. All of that will get taxed in the hands of the guardian, right. So the person may be a natural guardian, for example, the parents, right. So that's how we look at the concept of deemed assessee. And finally, you've got an assessee in default. So who are these? This is basically a person who fails to fulfill the obligations under the Act, and this person may be referred to as an assessee in default. For example, the person fails to pay tax or does not file the income tax return. Then let us look at the concept of the assessment year. So section 2 clause 9 provides what is an assessment year. It is nothing but simply a period of 12 months starting from the 1st of April every year. This is also known as the financial year, right. So financial year, we usually write it as FY. Assessment year is referred to as AY, and then we look at the concept of PY, which is nothing but previous year. So section 3 talks about what is a previous year, and it says that it is nothing but the financial year immediately preceding the assessment year. So for example, 2000, the year 2000, 2001 and 2001, 2002. So in the previous year of 2000, 2001, what have you done? You have gone and earned your income. And once you have gone and earned your income, then in the following year, we are going to assess that income for the purposes of taxation, right, which is nothing but your year 2001 and 2. So let's say, for example, you start earning from the 1st of April of the year 2000, right, and we are saying that your year is going to run from 2000 to 2001, which means it's going to end on the 31st of March of 2001, right. So whatever income you have earned during this period, that will now be assessed, right? So obviously only once you have earned your income, then only we can subject to assessment. So then in the year 2001-2, which becomes your assessment year, we look at the accounts of your previous year for the purposes of payment of taxes, right? So those were some very, very important terms which were there, and now we will look at a concept which is known as application and diversion of income. So when we look at this concept of application and diversion of income, basically we are talking about how you are supposed to meet out your legal obligations, right? So it says basically that under the Income Tax Act, every income that accrues or arises in the hands of the assessee is liable to be taxed, right? So what do we mean by accrue? By accrue, we mean that something is getting collected, right? And again, we use it interchangeably with arising. So arising, basically we can find the source and then we see that it is coming up. Accruing is, it has come up and now it's all getting collected. So we use the two terms interchangeably. So it says that every income that accrues or arises in the hands of the assessee is liable to be taxed. Now who can be these assessees? Assessees can be all those people that we have referred to as persons, right? So this assessee could be a company, this assessee could be an HUF, this assessee could be an individual, right? So an individual like you and I. So all of those 7 categories of persons that we have looked at. There may, however, be certain situations where such income is diverted before it reaches the assessee due to a legal obligation. In such a scenario, the assessee cannot be held liable to pay tax on such income as the income never reached the assessee. In other words, when there is a diversion of income due to an overriding title, the impugned amount cannot be said to be a part of the income of the assessee. For the principle of diversion of income to become applicable, the diversion should be effective at the very stage when the impugned amount leaves the source to reach the intended recipient. The person to whom the amount is diverted should have a legal right based on some pre-existing legal arrangement that entitles him to claim the amount directly from the source. This must be done without the intervention of the person who would have received the amount had there not been the said legal arrangement. Where an assessee physically receives the amount but is obliged to spend it in a particular way, then the income cannot be said to have reached the assessee. So there exists a fine line of difference between the application of income and diversion of income, which has, however, not been addressed by the Act. So the courts have actually provided a very broad set of guidelines through which this can be understood. So before we look at this case, I would want to go back and quickly discuss this aspect of, or maybe we can do it with the help of the case. So when we talk about some sort of income coming into your hands, right? So let's say, for example, you are getting 50,000 in your hand, right? When you're getting 50,000 rupees in your hand, it is really up to you, and I'm taking the case of an individual here. It's really up to you how you want to spend that 50,000, right? Do you want to go and spend, let's say, for example, 10,000 on your groceries, right? You want to spend another 5,000 on your entertainment. You want to go and spend another 10,000 on your utilities, right? And then whatever is the remainder, let's say, for example, you want to save it, right? So it's really up to you how you want to spend your income. Nobody can tell you this is how you must do and this is how you must not do. So when you have that liberty to use your income the way you want to, and you are spending it the way you want to, this is nothing but simply your application of income. Now, while over here I say that you might want to save, there might sometimes be an add-on, right? An add-on of you having some sort of a legal obligation. Now, this legal obligation could arise maybe because you have a minor child and you need to maintain that child, right? Without you actually having been pushed into the courts and being asked to maintain the child, irrespective of that. So as a parent, you are required to maintain your child, and therefore there is some amount that you are using for your child also, okay, or you are giving out some amount to your spouse, right? But over here, whatever is happening, it is as per how you want it, right? Of course, they are liable to be maintained out of your income, but at the end of the day, you are doing it out of your own free will and meeting out these legal obligations as you would want to. So this is when we are looking at the concept of application of income. Contrast this to a situation wherein again you are earning 50,000, right? And this income, let's say for example, again you're spending it in similar ways. So you've got 10,000 on groceries, you're paying 5,000 on entertainment, you are paying another 10,000 on your utilities, and you have got some legal obligations together with you wanting to save some amount, right? So over here, if you see, you have earned 50,000, and at the end of the day, what do we see your income as? We will see that, well, this person has earned 50,000 in that month, okay? Or let's say annually. So annually, you have received 50,000 in your hand, and therefore you are liable to pay tax on 50,000, okay? Of course, we are not looking at the thresholds, and I'm trying to simplify the figures over here so that we are able to understand, right? We are not looking at tax slabs. So when you are receiving that income of 50,000 over here, the amount of tax which has to be imposed, keeping in mind that you have earned 50,000, right? Now over here, if we look at this second example, let's call this example A and example B, right? So when we, no, not B, we will call it D, because we are looking at now the concept of diversion of income. So when you have got all of these different heads of expenditures that you are possibly looking at, you are also looking at a legal obligation, right? So let's say for example, you have undergone a separation, okay, and there is a divorce which has taken place, as a result of which now the court has obviously intervened and said that you need to maintain your spouse, or you need to maintain your child, or you need to maintain your parent or parents, right? So either you are maintaining your spouse, or you are maintaining your children, or you are maintaining your parents, right? Now when you are going to maintain all of this, all of these people, the court might say that, well, we are looking to secure their maintenance, and therefore because you have this property in your hand, a house property for example, right? So the court can create a charge on this property, right? So once a charge gets created on this particular property, then whatever income is coming through from this particular house property that was initially coming to this person right? Whatever, let's say for example, rental income was coming, right? And that was a part of this overall 50,000 that the person was earning. This rental income will no longer reach the person over here, but would rather be used to meet out the maintenance of the spouse, children, parents, whoever, right? So when that charge gets created on that particular property, then whatever rental income, let's say for example you were getting 10,000, right? That 10,000, courtesy the charge being created on that property, will now go to the spouse or the child or the parents, right? And therefore your income that is being looked at will not be seen as 50,000, right? So while you are earning 50,000, but because a charge has been created on this particular property, and that amount will be used to meet out the maintenance of the people who are entitled to be maintained out of the income, therefore that income that the person has earned through the year would be treated as not 50,000 but rather as 40,000, okay? And your income that we are looking at as the income that is your total income, the income that we are going to look at for the purposes of taxation is going to be 40,000 and not 50,000, okay? So we are no longer going to tax you on the amount of 50,000 but rather on 40,000. So if you look at the cases, usually you will see that there is a fight wherein the assessee is trying to show that there is a diversion of income and not application of income. Why is that? So if you look at application of income, how much are we paying tax on? We are paying tax on 50,000, right? So if your income is 50,000, then obviously the amount of tax that you will pay will proportionately be higher compared to the amount of 40,000. So if your overall income is lesser, your tax liability also goes down, and because your tax liability goes down, you are obviously not having, you will not be shelling out that much of money towards paying your taxes, and therefore there is this usual tussle which is there wherein the assessee wants to show it as diversion of income and not application of income, right? So now let's look at this case of CIT versus Seetal Das Tirath Das against this entire backdrop that we have discussed, wherein the apex court, which is the Supreme Court, had ruled that mere discharge of an obligation in itself is not sufficient to be categorized as diversion. It is the nature of obligation which is the decisive factor. It further held that the true test is whether the amount sought to be deducted in truth ever reached the assessee as his income. So where the obligation income is diverted before it reaches the assessee, it is deductible. But where the income is required to be applied to discharge an obligation after such income reaches the assessee, the same consequence in law does not follow. The second payment is merely an obligation to pay another a portion of one's own income which has been received and is since applied. The first is a case in which the income never reaches the assessee, who, even if he were to collect it, does so not as a part of his income, but for and behalf of the person to whom it is payable, right? So when we talk about this income never reaching the assessee, right, even if he were to collect it. So when we say even if he were to collect it, so let's say for example this person goes and collects this rental amount of 10,000, okay, but still this income of 10,000 will not be used for the purposes of calculating this person's income. Rather, it will be deducted, right, and therefore he will attract lesser tax liability, right? So while deciding the above matter, the court contrasted it against the facts and circumstances in the case of Bijoy Singh Dudhoria versus CIT. In this case, under a compromise decree of maintenance obtained by the stepmother of the assessee, a charge was created on the properties in his hand. The Privy Council held that the amount of maintenance recovered by the stepmother was not a case of application of the income of the assessee. So over here, what had happened was Bijoy Singh Dudhoria, he had to pay maintenance to his stepmother, right? So the stepmother had to be paid some amount of money, right? And to secure this amount of maintenance that was supposed to go to her, the court had created a charge on the property of Bijoy Singh Dudhoria. So once this charge was created, the amount that was given out to the stepmother, that was seen as something that was deductible for Bijoy Singh Dudhoria, right? So going back to our similar example, right, wherein we were talking about 50,000 and then we said that, well, your 10,000 is going out as diversion and you are going to pay tax on only rupees 40,000, right? So over here, when the charge was created on this particular property of Bijoy Singh Dudhoria, this amount got deducted, right? Why? Because over here, this amount was to be treated as one wherein there was diversion of income, right? So the Privy Council in this particular case further stated that when the Act subjects to charge all income of an individual, it is what reaches the individual as income which is intended to charge. In the present case, the decree of the court, by charging the appellant's whole resources with a specific payment to his stepmother, has to that extent diverted his income from him and has directed it to his stepmother, and to that extent what he receives for her is not his income, right? So he may be receiving this particular amount of 10,000, but of course he has to give it out back to his stepmother, okay? And because he has the legal obligation to give out this amount to her, courtesy the charge that has been created on his property, therefore this 10,000 that he may be collecting on her behalf, it is not to be treated as his income, but rather the stepmother's income, okay? So that's what I wanted to share with all of you today, and I hope that you all have been able to understand the concept of application and diversion of income together with our definitions, which are very, very important, and also that how is it that we are looking at taxes overall. Thank you.
Hello, I am Professor A.K. Sharma and I teach sociology in IIT Kanpur. I am taking up a question, what is world population crisis? World population crisis refers to explosive growth of population which occurred during 1950s and 1960s. For millions of years, some people estimate that perhaps man appeared on this planet Earth 5 lakhs years ago. It took these 5 lakhs years for world population to reach first billion in 1820 AD, and that means that the population in ancient times must have been rising at rate 0.000 something percent per year. Now in 1950s and 1960s in the world, you find that population started growing at rate more than 2% per year. This is what is meant by population crisis. You can imagine that if a population grows or anything grows at 2% per year, then in about 35 years time it can double. And obviously, particularly in the context of less developed countries, it had implications for poverty removal, for employment generation, for maintaining health, improving life expectancy, raising educational levels, etc., etc. The reason behind this population crisis was improvement in life expectancy or improvement in general health standards of populations. You may not be knowing, or you will be surprised to know that about 100 years ago in our country, life expectancy means average age of death or average age of life, whatever you say, of a newly born child was only 20 years, and today it has reached the level of 68 years. Much of this improvement in less developed countries occurred in 1950s and 60s, and therefore, with improvement in health, improvement in life expectancy or average age of birth, average age of death, and population started growing at explosive rates, and people started writing about this. This is population explosion, or this is population crisis. And now one can say that the period of peak growth rate is over, and from 1971 onwards, in the world as well as in our country, growth rate of population has started declining. Now, in India, you may like to know what is the current growth rate of India's population. Currently, India's population is growing at 1.5% per year, and the reason is that after sudden or unexpected improvement in health conditions in 50s and 60s, which led to population crisis, average number of children has also started coming down. So, there was a time when average number of children per woman was around 11 or 12, now it has come down to 2.5, and therefore, the growth rate of India's population has come down to 1.5%, and we can hope that in the future, means in the coming decades, even if nothing changes on the front of fertility or number of children, India's growth rate of population will decrease further and eventually come to a zero level, as said by the 11th 5-year plan of India. And now the major cause of high growth rate of population is not high fertility, but the age distribution of population. So, we have a high percentage of population at the younger ages, and that is the cause of high rate of growth of population. Eventually, when population of India will also age like population of other developed countries, our growth rate will start falling. Thank you. Now, we will meet in the future.
Hi, my name is Gillette Sam, and I teach sociology at IIT Kanpur. One of the things you must have noticed if you read or if you talk to people around you is that they often refer to something called globalization, or they often say we live in a global world. What does this mean? Today I'll tell you about how to think about globalization or interpret the word global in a sociological manner. When sociologists refer to globalization, they refer to three things. The first is that that it involves transplanetary processes, which means that something is going on across multiple borders, right? The second is that it involves heightened liquidity and interconnected flows. Now, by liquidity, and this is a term that was coined by the sociologist Zygmunt Bauman, we refer to the increasing interconnectedness of things across the globe, but we also refer to increasing instability across the world, which means that potentially something that is occurring many many kilometers away from you, actually influences the place that you live in. So if there is a natural disaster happening in one part of the world, maybe that causes people to migrate from that area and they come and settle where you stay. So that is what we mean by liquidity. And of course, when we are talking about liquidity, we are talking about things that are really moving from one place to the other. Now, the third aspect, and this is something that you may not conventionally come across in the way people use globalization, is that of structures. So, let's take an example. Supposing I, as an Indian citizen, wish to visit a foreign country. Let's say I want to go to South Africa. Can I just pick up my bags and hop on the next plane and go to South Africa? Any logical person is going to say, no, wait, you need to have documents such as your passport or visa. Now, this passport or this visa is a representation of the larger structure that governs how people move across borders. So, we have things like border control, national security agencies that consider what kind of people are going to move from one place to the other, correct? So, when we think about globalization, an average person typically tends to think about things moving or people moving from place to place. As sociologists, we also consider that there are structures that facilitate or direct this movement across multiple borders.
Hello, I am Shikha Diksha. I teach psychology and I am with the Department of Humanities and Social Sciences at IIT Kanpur. Today I am going to talk about what is social cognition. Social cognition is a research area in psychology which explicates the various cognitive processes that people employ to understand the social world. So, essentially it is about sense making of the social world, which involves understanding other people as well as understanding oneself. Understanding others requires understanding their traits, their internal tendencies, their contextual aspects, motives, feelings, emotions, etc. So, as we can see, this is a very complex process and requires a massive amount of information processing. Even for small decisions, for simple decisions, people have to process a large amount of information. The main perspective or the approach which is used in social cognition is obviously the cognitive approach, and which is the study of mental structures and processes. The main paradigm which is used is the information processing paradigm. As far as the range of topics in social cognition is concerned, the range is very wide, from individual level sense making to collective sense making. As far as views of cognitive sense making are concerned, there are three major dominant views in social cognition: the naive scientist view, the cognitive miser view, and the motivated tactician view. The naive scientist view emerged from research done in causal attribution, and this refers to detailed and systematic processing of information and sense making in the social world. However, it is not always possible to make detailed engage in detailed cognitive processing, and hence people act as cognitive misers in many situations. So, whenever there is lack of time and cognitive effort is less, then people involve in using certain strategies which are functional, yet they are like mental shortcuts. So, this is the cognitive miser approach. However, the question that comes to the fore is that which one of the two strategies is more important? The answer is provided by the motivated tactician view. And according to this view, people can either use the knife scientist approach or the cognitive miser approach as and when required, and they can switch over between the two approaches when required. So, these are the three major views which are utilized to understand cognitive sense making. The topics that social cognition covers ranges from cognitive social cognition to social cognition. So, topics such as causal attribution, understanding of attitudes, social schemas, unconscious cognition about social situations, the use of mental shortcuts or heuristics in decision making, social identity and stereotyping processes are some of the topics. In addition to this, a large number of social cognitive psychologists also understand collective sense making in terms of social representations.